Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Hi, this is Greg Friedman, CEO of Peachtree Group, and this is another episode of Peachtree Point of View, our podcast. And today I'm joined with two guests, so I'm very fortunate. One is Mark Woodworth, and Mark has been a huge asset to Peachtree through the years. Has helped a lot when we're looking at different markets and helping provide feedback and thoughts as we're investing in the lodging space. And he's joined with Jack as well today. But we really want to talk about the hotel industry and what's really happening as we're navigating through this current cycle that's had a lot of challenges with higher for longer long-term interest rates. You've had the impact coming out of COVID and a lot of other factors that have shifted how demand is occurring at hotels, across the different sectors. And, you've had some, supply challenges, and a lot of those supply challenges, fortunately, are starting to wane a bit, but we'll talk more about it. But to really open it up, I guess, Mark, I'd love for both you and Jack to sort of give your background, and then let's sort of talk about the hotel industry.
Yeah, Greg, first of all, thanks for the opportunity to spend a little bit of time with you this afternoon. And we've been big fans of yours and the company, and set aside the fact that one of our sons works for you, that makes me a little more biased. It's been a great relationship, as you just noted, for a long time. I've been in the advisory side of the business virtually all my career. I'm going to fast forward through most of it. In the late 1980s, I got a call from my alma mater saying there's somebody there at Georgia State on the faculty that we're recruiting to come start the real estate program within the hotel school up at Cornell. And so that's how I first got to meet Jack. About 5 or 6 years after that, Jack, I think I successfully talked you into initially joining us part-time and then full-time and starting a research-based practice at the old PKF Consulting. Fast forward from there, we sold the old PKF Consulting, PKF Hospitality Research, to ultimately to CBRE. I oversaw global lodging research for CBRE up until 2020. And that's when I left the firm and started my own little shop. Jack, I like your story better than mine, so go ahead.
Well, up until 1999, career was entirely academic. My training was in real estate, finance, investments, financial economics, macroeconomics, a number of other subjects that I found interesting during my graduate studies. Anyway, in 1999, Mark and I joined forces and started PKF Hospitality Research along with our other colleague, Robert Mendelbaum. And as Mark described, that continued on until we were purchased by CBRE. And I continued at Cornell sort of half-time and did the work at PKF and CBRE the other half. So Mark and I have been business partners a long time. We may throw a few jokes back and forth at each other during this podcast, but there's no hard feelings between us for sure.
In fact, Greg, if you'll indulge me, this is the time of year where I've learned over the years working closely with Jack that when he comes out in the morning and sees his shadow, it means something in our industry. And what I have found over the years is that it's a very good predictor of how accurate the national forecasts are for hotels. So Jack, and Greg, if it's okay, Jack, seems most of the firms that are in the business today, the domestic forecast is for RevPAR is a +1 to 1.5. What does your shadow tell you, or lack of shadow tell you? Is that aggressive? Is it likely right on, or is it a little light? It's going to do better than that. What's your sense?
Well, it's certainly going to be 6 more weeks of winter, but hopefully not 6 more years. I think those estimates are right at the sort of level of central tendency. So I don't think 1.5 is going to be exceeded by much, but it could go slightly negative as it has in the last 12 months. So I would not sort of contend those numbers. I think they're probably the safest way to go, and probably a conservative way to go as well.
So you bring up a good question, just like listening to y'all talk about it, about the, what's you predict, for the next, or for 2026, what you think is going to happen, and potentially having, negative RevPAR or really flat RevPAR within the lodging space. You look over the last 3 years, 4 years, I feel like, going back 3-4 years ago, it was about survive to 25 across, the hotel space, commercial real estate in general. We got through 25 and, and there was, obviously demand was recovering coming out of COVID. But the one thing that's really taken shape is that K-shaped recovery, this K-shaped economy that we're facing. I mean, how do you see it just impacting the different segments from y'all's perspective? Because on a macro basis, we may be flat. I mean, do you see certain segments outperforming others? And do you think that trend of the K-shaped economy, are we just sort of stuck in that trend long term, or do you think anything's going to change it?
You want to try take that with Jack, and I'll chime in?
Yeah, sure. I definitely think we're stuck in a K-shape. And the Baird analysts did some surveys at the Alice conference recently, and the respondents pretty much confirmed the same. I did a quick analysis of Marriott and Hilton on the upward sloping leg of the K, and Choice and Wyndham on the lower segment of the K. And the returns last year, over the last 12, 13 months, are strikingly different. 62% positive for Marriott and Hilton, and negative 44 and negative 36 for Choice and Wyndham. They may not be that dramatic, but I think at least those shapes are going to continue to be evident in the public markets. And the other cautionary note is these numbers that Mark and I were talking about, the 1.5%, those are gross aggregate numbers. So they take into consideration both segments of that K. So, I learned a long time ago that these markets are local and they're specific to assets. So you can get some takeaways about allocating to a certain sector, such as hotels, from aggregate numbers, but it's really, the wins really come by finding the outliers from the general numbers.
Yeah, and I think the disparity in performance across the chain scales, I would say it's got to be greater than I've ever seen in my 40 plus years of doing this stuff. And if you just look at the behavior of luxury and upper upscale for the past 4 quarters, just take those. I think the numbers, according to CoStar, was like a plus 5.5 RevPAR for those two segments. And you take the lower two, and it was a minus 5.5 or thereabouts. So a huge disparity in performance. And Jack, I don't see the disparity getting any bigger, but I also don't see it getting much narrower over the next 12 to 18 months, just given the way the economy is playing out and just how we think. Well, another interesting statistic, I was talking to a former colleague of ours and longtime friend, Jamie Lane, who runs AirDNA's research practice. We were in a meeting and he pointed out that the travel deficit, it was a travel surplus of 70 billion, inbound travel surplus, 70 billion back, I think it was in 2018. 70 billion more dollars came into the U.S. from inbound foreign travelers versus the outbound domestic. In 2025, plus 70 went to a minus 50. So it shows you that. So when we try to explain why have certain markets and certain property types been weak, part of the explanation begins with, let's understand how dependent historically we have been on that inbound international traveler, and when is that going to come back? Now, Jack, I happen to think whatever the low point of that phenomenon was is now behind us, and it'll slowly begin to come back. And obviously, that's most relevant in the gateway cities and so forth. But what's your take?
Well, I have some Canadian friends who pretty much disagree. They're gonna hold fast and not travel into the U.S. It's actually some good friends who usually travel to the U.S. for the winter are in Spain now. They may not be crossing the Gordie Howe Bridge anytime soon either. We'll see about that.
But Jack,
anyway, Canada's a big story.
Jack, did you ask him, can't you take a joke? No. Okay.
As a sidebar, a big part of the Las Vegas story is the Canadians have not shown up, and they're down 20%.
Did you see, is the international travelers, because I don't have any data to point to this, but does it impact, more of the mid-scale segment greater than the luxury segment, or is that part of the driver at all to the K-shape, or the impact where mid-scale is really flattening out or even declining in some cases on RevPARs, and then everyone's dealing with just expense creep and so forth?
What do you think, Mark?
Jack, you want to take that one?
I don't really know. I don't have data to support it. sort of off the cuff assumption is it's fairly across the board, but I don't think it's at the very lowest level
Yeah,
of the.
I did some years ago look into this. At the time, I found it very surprising because there's sort of, I just assumed, inbound international travel, it's got to be people that are not that price sensitive, lots of disposable income. That's why they're making the trip and so forth. But it turned out there was a chunk of it was that more mid-market tour group kind of traveler. They're traveling in big blocks and they're going to the New Yorks and the Chicagos, et cetera, and San Franciscos. So as Jack said, it is across the board, but there is a chunk that's right there in the middle. So we look at these urban markets with the mid to upper mid scale properties. That's part of it explains why their business has been off.
So coming out of COVID, man, and we started talking about this now with international travel, obviously being down as great as it was, but demand patterns have shifted some. Do you see some of these shifts? The international travel, I guess we could probably debate it. It feels a little bit probably like it's transitory to a certain degree, because I do think some of that's politically driven right now. But do you see some of these shifts being permanent at this point in time? What do you see there?
Jack, I'll start on that one. And I confess, I am a glass half full person. So filter what I'm about to say as you think is appropriate. But this may end up being a 4-year phenomena that it's easy for people to not like a certain person. And so they drive their behavior or certain behaviors around that. So, maybe the outside of this window is another 3 years. But again, there's a reason why for decades, so many people that don't live here have wanted to come here and experience the culture, see the major cities and so forth and so on. So I'm hard pressed to believe that won't come back like it was. Maybe just it'll take a few more years than perhaps ideally I would like. But Jack, what say you?
I would agree 100% with that.
So looking at the industry, because from what we see, and it sounds like y'all probably agree, you have a certain segment that's challenged with increasing expenses. It's hard to drive RevPAR just because you just have less demand for that mid-scale segment right now. You're not able to drive the rates that you're seeing on the luxury side. Is it just long-term? Are you just more bullish on the luxury segment, just knowing that luxury, historically, it feels like luxury has been more, or at least been steeper when there's a true downturn, which I don't feel like we've faced one at this point.
Yeah, well, I would say, let me, for purposes of this answer, let me define luxury as kind of upper upscale and luxury. Okay, nice 3.5 to 4 star and above properties. I think that the demand for that particular product type has been growing nicely and will continue to grow. I think one of the inputs to that belief is the fact that if we look at the number of people that have the two attributes that one needs to have to make a trip away from home, i.e. they have to have the time to go make the trip and they have to have the economic resources to pay for it. That segment of the population has been growing and has continued to grow at a very, very fast rate. And that's going to persist for quite some time. I think, Jack, part of this other, again, I learned this from you very early on, is this whole notion of new beats old. And if we look at the aging of the hotel stock domestically, and how that varies across markets, Jack, doesn't that help to answer why there's such a disparity in performance among the different properties? It's not so much totally on the demand side, but it's also on the supply side, given the product that's available. Does that make any sense to you, Jack, or not?
Yeah, it could be. Again, I don't have any data on that, but to go back to the luxury question, I was pretty bullish on luxury for some of the reasons you described, Mark, the amount of wealth creation in the United States, largely through the public markets. But I sort of put back a little when Host announced that they were going to sell 2 Four Seasons, one in Jackson Hole and the other one in Orlando. And there were some reasons maybe why they shouldn't have bought them to begin with that the analysts pointed out. But maybe from an investment standpoint, luxury has peaked, and that maybe there's not much juice left in the luxury investment play, even though the RevPARs are going to outpace the RevPARs for some of the lower segments. So Host didn't announce how they're going to redeploy the capital, which is something that I'd be very interested in to see what they're going to do with it. It's like $1.5 billion. These are huge, valuable assets. But all in all, from a pure economic standpoint, luxury and upper upscale look like the places to be.
Yeah. So from when you're looking to, because you talk about the investment side, like what benchmarks do you think correlate just to the performance of hotels? Like, is there certain benchmarks that you would pay more attention to from your perspective if you're looking to invest into hotel assets that you think are more critical for how they should perform in the near term or over the next several years?
Yeah, Mark and I cheated on this a little bit. We traded notes
Right.
before this talk. Was that allowed in these podcasts?
Yeah, it's totally allowed.
Okay.
Yeah, so you're giving away our secrets now. But
I presented the case to Mark that I want to see real ADR growth, real growth in the price of hotel rooms. And we went back and looked at some data, and it was clearly there during the early part of this century, the past decade for sure. It tailed off. Then we had, of course, a good year in 22 or 23, Mark, one of the others. Until I see, the CPI inflation last year was 2.7, right? So if we're tracking along on that path, I want to see ADR growth north of that number to be excited about making an investment in the hotel space.
So
I was
gonna say
I agree with that, but I think within that, and again, Greg, not just to make you guys feel good, but if you just look at where you guys have been deploying capital in the markets and the places like San Antonio and Austin and so forth, I mean, we've seen some very attractive real increases in ADR. And I think that there's a terrific story around those kind of markets from an employment perspective. And again, Jack, one of the list of things I learned from you, employment is one of the key indicators of where you could expect to see changes in lodging demand. So i.e., if employment is expanding, lodging demand is going to expand. And the opposite obviously is true. Income being the other variable that we look at very, very closely in terms of being correlating well to changes in demand.
So let's talk about the valuation side just of hotels today, because we went from this 0% interest rate environment pre-2022 for 10 to 12 years, where interest rates were effectively next to zero and the 10-year averaged around 2%. The 10-year is closer to a little over 4% today. Do you feel like assets have fully repriced, or do you think there's risk, especially with the jobs report today coming out where it was relatively positive? I think it probably supports the 10-year sort of staying where it's at. I mean, you see risk that cap rates could go higher? Or do you think they can press down, or what's your take? I guess, Mark, maybe start out with you.
Go ahead, Jack.
Did you want Mark to?
Either one of you, go for it.
Okay.
Well, yeah. Oh, go ahead. Yeah, go ahead, Jack.
Well, there's really no evidence that cap rates have had much movement recently. They're pretty flat. The CBRE half-year survey just came out, and it was dead flat. So it's not clear that they've been moving around much to begin with. But if you look at the three pieces of using the standard models of cap rates, three pieces: risk premium, risk-free rate, and growth in income. We've already talked about growth in income. It's pretty low, not moving much. And the risk-free rate is, and you have to be careful with the risk-free rate because cap rates are pegged more to the 10-year. They're not pegged to the federal funds rate. So what the Fed does may have other than working on its portfolio, selling off, buying 10-year treasuries, the Fed funds rate really doesn't have a lot to do with cap rates or long-term rates. The 10-year has been moving down a little bit. And so I really don't have any strong feelings that the cap rate is going to move much because the three pieces tend to offset each other. And that's one of the tricks of really interpreting cap rates from a traditional modeling standpoint.
Yeah. So if just to try and pin you down, Jack, so directionally, if there was and I agree, I can't come up with a reason to think they're going to change much one way or another, but directionally, if they do in fact change, which way do you see them going?
Slightly downward.
Yeah, me too. Just not by a bunch, but at least we're going to head that way. And I do think that, again, barring some kind of catastrophic event or, COVID-2 or any of that kind of stuff, I do think we're going to see some pretty good NOI growth. Not so much this year, But I think the back half will start to evidence itself. But I think going into 2027 and for the balance of the decade, and Jack, you've heard me say this for a while, I've thought they will end up being some of the best years that we've seen in our careers in terms of overall income growth. But right now, there's a lot of noise in the system. It's got to work its way through. And obviously a lot of stuff has happened that we couldn't have predicted, like, pissing off our neighbors to the north and others around the world, and so they don't come here anymore.
So Mark, what gives you that optimism on the back half, really looking over the next 3 years, that we're going to have some of the best income years in lodging? And when you say that, I'm assuming you're really speaking to all segments, but I'll let you sort of clarify that, because that's something great to hear.
Yeah. I think it's generally across all segments, more so than in others. But again, it's this bulge of wealth, the whole baby boomer phenomena thing, that they're going to be hitting the road and spending those resources, and hotels will benefit. And I think the numbers are pretty clear to me anyway, that's a very reasonable expectation that we can look forward to for the balance of the decade. But Jack, what's your current thinking on that?
Yeah. Well, I'd like to take a geographic perspective on this. I've always believed that the locales, states, communities that have no income tax, they have right to work laws, low regulations, good weather, in-migration, all of those things that point to the South Carolinas, the Texas, the Floridas, those areas will continue to outperform and probably generate the kind of growth that Mark is talking about.
Yeah. And so we have a few minutes left here, so I could talk to you guys all day. So this has been incredible information. And I'm sure everybody listening really appreciates y'all's insight, because y'all do have, really good insight and knowledge of the lodging space, especially the investment side of it. But if you had $100 million hypothetically to invest today, and you had to invest in the lodging space, so you couldn't buy treasuries, where would you invest today within the hotel space? Or would you even invest at all?
Jack, may I go first on that one?
Go for it.
Okay. Understanding I'm a risk-averse person, okay, which to me says I'm going to play on the debt side of the business. That's where I want to be. I'm most comfortable being in that first position or in the right situation. Maybe I'll sit in the middle somewhere. But I just think that, and particularly if I'm right in that we're getting ready to begin a slow ramp up on valuations and so forth and overall performance, that I like the comfort of being in there. But again, like I know you guys are doing, there's other things, and we've been involved with some public-private deals and just other, traditionally, non-real estate economic benefits that are out there, like the OZ stuff you guys are doing and so forth, that where there's opportunities to leverage off of that. I think those are some pretty interesting plays as well.
Yeah, I would agree with that 100%. I think if you can get an 8.5% coupon on a mortgage debt investment, that looks pretty good. And then being incredibly selective in those equities in those markets that I mentioned earlier, the ones that have the absence of state income taxes and that sort of thing, playing in those markets in the equity side. But one side note, I saw the Vanguard chief investment officer who makes a lot of wealth management decisions. He just flipped from 60-40 equities to 60-40 debt. So he's alone out there, but I think there's a lot of other people thinking that maybe they ought to be on the debt side of the investment spectrum rather than the equity side at this point.
Yeah. And as you know, we're very much focused on the credit or debt side. You do a lot of investing on the debt and credit side. So we're, very bullish on having that downside protection in an environment that, feels very flat. And there's no question there's a lot of challenges within the lodging space, but there's those challenges have created a lot of opportunities, and there's a lot of dislocation the lodging space today that we continue to take advantage of on the Peachtree side, and a lot of other investors are doing the same. And probably one of the biggest dislocations are just within the credit market and the ability, in a lot of cases, to get be in a position where you have that downside protection and you're getting outcomes that are very similar if you're taking last dollar risk on the equity side. So it almost pays just to be on the debt side in a market that still has some uncertainty. So really appreciate you guys joining today. This was, very insightful. And as always, really appreciate your insights, Mark. And, Jack, always been a huge fan of your research and information as well, too. So really thank you for joining us today, guys. And this has been another episode of Peachtree Point of View. So thank you for joining.
Yeah, thanks, Greg. Thanks for the opportunity.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.